Let's talk ETFs and a lot of growth here in Chicago's quantitative models. Petra Bakosova is the CEO and manager of the whole tactical US ETF. And great to see you again, Petra. Thanks for coming in.
It's good to see you, Oliver. I love this new location. This
Thank
is
you
very
much.
exciting.
We met in my last gig kind of early on when I first came to Chicago.
Yes.
And I think it's an amazing trajectory that you've been on, because one of the things about the show I wanted to do was realize, that we're always talking markets.
Yes.
But in the time that I've known you, guys' fund, HTUS, which just celebrated its 10th year,
Yes.
also crossed 100 million around the same time.
That's correct. And I think you sort of have been along for the ride for our entire trajectory. I think when we first started talking, we probably had a 6-month model. Maybe we were toying with some 1-month models. And now we have put so much effort and new models into the ETF. We're really pushing the boundaries of what can be done and is done in an ETF wrapper.
That's why I love this conversation, because when I've got this show, but I've also tried to build my own business. I've been working more in the pipes of finance. I've worked with advisors and product managers, and I realize how hard it is now to get to $100 million, especially when you have a fund that's using options, that's using a quantitative model, that a lot of people are trying to go after that market. So what's kind of the secret sauce that you think has been a winning sell for this fund?
I would say our secret sauce is like not having a secret sauce in a traditional sense. Like, we're not trying to do anything that's, we're not going after any really expensive data sources. Like, our premise is you can use public information that's out there, and you can, through a careful quantitative analysis, you can combine small edges, and we call these small edges micro alphas. We wrote a paper called Micro Alphas, and our thesis is you can combine these micro alphas in a smart way and use machine learning and AI to do smart modeling and produce a small but consistent edge for your investors. And over the long run, over 10, 20, 30 years, these small edges accumulate and it create a meaningful advantage.
You're a 5-star fund on Morningstar. Tell me about how you frame the goal. Is it to beat to the upside? Is it to lose less to the downside? Is it to do both at the same time? Because a lot of what I see using options in particular is funds that target reduced downside, but then they kind of lag a little bit to the upside. What's the main goal, and how do you think about it in that simple framing?
Yes, I wouldn't say we're trying to be some kind of a tail risk hedge. We don't want to give up the upside. And so what we're shooting for is almost like a stackable portable alpha type of a fund that on average we will be 100% invested in the S&P 500. We think the S&P 500 over a long run, really hard to beat, should be a core component of everybody's portfolio. But we're trying to add these overlays, whether it's the market timing overlay, if you will, or these options overlays on top of the S&P 500. So when our signals are bearish, we will be less than 100% invested. When our signals are bullish, we will be more than 100% invested. And then hopefully we create both upside and downside capture advantage for the clients.
You've talked about your market sentiment meter that you use. To your point, you look at public information, look at things like PMIs. You just caught me up to speed that right now that's at like an 87% positive reading, or how do we interpret that?
Correct. So like today we're 87% invested in the market. So that means we're not very bearish, but we're bearish. So anything less than 100% for us,
Anything
a little
less,
bit
okay.
bearish.
How much do you go to the upside?
We could go all the way up to 200% long, and we could go flat.
Okay, and will you typically use options for that, or how do you achieve extra upside the same way that you hedge downside?
Oh, we have a wide variety of asset classes at our disposal.
Okay.
We can invest in the SPY, ETF, E-mini futures. We will acquire a certain portion of our deltas, long deltas, through SPX options or XSP options. We have the ability to trade VIX futures as well. So it really is, we look at which products are most overpriced, underpriced. We look at where people are, creating some market dislocation through excess buying, excess selling, and then we accumulate the position where we think is the most advantageous.
Are there any particular products that you find yourself using more of or more frequently than say a few years back, and I'll kind of prime the question with a few examples of guests we've had on. A lot of people using flex options,
Yes.
but a lot of that's kind of coming from the buffered side, kind of fixed items. Obviously, we talked a lot about zero DTEs. So there's a few in there.
Yes, no flex options.
Okay.
We sort of tend to be,
Too
interestingly enough,
expensive or what?
we
It's
think
not for your style.
we think market makers love them, and when market makers love something, we probably don't love it so much. So we're staying away from those, and we also tend to be on the other side of the buffer ETFs, if you will.
Right.
Like the buffered ETFs tend to like serve, I would say like certain fears of investors. People are looking for tail risk protection, are defensive, want to or are willing to give up upside, and we're sort of saying like we're being really rational, systematic, disciplined. So we're probably going to be on the other side of some of these trades.
Okay.
We did embrace zero DTEs. We do have zero DTEs, especially we saw a huge flow of retail traders going into the zero DTE market, which we felt created a lot of opportunities for us. So we are in zero DTEs.
Now, do you find, right, not exactly the market makers. Now, do you find that you're usually using those to bet against bigger moves? Are you kind of taking the more short gamma side while people are trying to catch these like big inflection points where more often they're going to miss those than hit them?
We are actually both. We're not just selling them, or we're not just like shorting strangles in the zero DTEs. Depending on what our models tell us, we can be both long and short.
Okay. Thinking about how your background, you study mathematics on an extremely high level at University of Chicago. Tell me about that and kind of how that informed. And also, Blair Hull he's a former Blackjack guy, right?
Yes.
Where do you guys find that kind of middle ground? We were talking with Joel earlier about poker. We're poker players.
Yes.
And the real kind of like obsessive math people are Blackjack people because they're willing to take on a very like almost non-existent edge.
Yes.
So how do you kind of combine the very quantitative pure math side with that kind of background of the speculator?
I actually think they blend very nicely. I would say there's like certain lessons that Blair learned at a Blackjack table that we sort of adapted and integrated into our investment process. So one would be bet often.
Okay.
So as you said, like the Blackjack players, they will take the tiniest advantage and then they will play, 100 hands an hour for 8 hours a day, do it 50 weeks in a row, and then
so hard that even Bill Gross got booted.
Exactly.
Had to give it up.
So we do believe that, and that's partially why we shortened some of our forecasting frequencies. We went from a 6-month model to a daily model. We're trying to see if we can find edges on the intraday basis. So we try to bet more often, and then just like the Blackjack players bet proportionally to their advantage. That's what we do. All we try to do is like how confident our models are that we should be bullish or bearish, and we always try to like scale our bets proportional to the size of the perceived advantage that we have.
Yeah.
And last but not least, stay in the game.
Okay.
Don't blow up.
Right.
So risk management.
That's exactly what the AI was telling us when we looked at that too, is the importance of not tilt, not blow up. So the point about knowing when you have an advantage, and I don't know how easy this is to answer without understanding how your algo works, but I think for a lot of people it's a really important point. What are the signs that you have an edge? What are the signs that, okay, this is when I do want to apply leverage? Is there a way to think about that simply for kind of the everyday person?
I would say this is, the $1 million question. So what we do all day long, we have a group of 15 quants that, look at data and derive features from the data and build models and build back tests. And then we deploy the good-looking models into production, then we trade, and we have a traded performance, and we accumulate realized returns. And these accumulate kind of slowly, and it's really hard to tell the difference between like when your model is going through like a temporary period of drawdown versus when your model was overfit in the first place.
Right.
So I think sadly, there is not a simple yes or no, I have an edge and this is how big my edge is. It's really hard to measure. And you just try to be as quantitative as in your back testing process as you can, and try to eliminate overfitting and forward-looking bias and all the different mathematical errors.
That's where poker is easy because you just pay for a GTO model and tell you if you did the right thing or not, or the math is confined. Now, to that point though, is when you think about AI, where is there an ability to insert that in? And has any of your kind of modeling been able to be replaced, supplanted, augmented by AI? And how should folks be thinking about that and understanding your own approach?
I would say I like the word augmented.
Okay.
So we don't use AI to replace our investment decision making. We use it, I would say, two ways. Like one is that's already being in place. Just kind of like looking for suggestion, new indicators, maybe critiquing our model, critiquing our approach. That's been really interesting.
Okay.
And then second, one of the cool thing that I'm really excited that we're about to do, we're just weeks of launching our own Kaggle competition. I don't know if your viewers are all familiar with what Kaggle is. It's a data science platform run by Google, where basically thousands of data scientists from around the world compete at predictive models. So we basically are sharing our data set with Kaggle.
Very cool.
We're asking thousands of data scientists around the world, like, give us your best model for prediction of next day's equity risk premium.
Nice.
And we're gonna find out what they can come up with.
Very cool.
Yeah.
Petra, great conversation. Love the details, love the insight, catching us up to speed on the model and markets. Appreciate it very much.
Oh, thank you so much for having me.
Absolutely.
It's good to be back.
Stuff. Very cool.
Yeah.
And congrats on the huge growth in the fund as well. HTUS is the ticker, the whole tactical. Petra Bakosova, CEO and fund manager.